Here's something you might not know. There's a shipping route from Shanghai to Europe that saves a full 6 days compared to traditional routes. This passage didn't even exist before 2017 because it was locked behind ice sheets several meters thick for thousands of years. But today, nearly 40 million tons of cargo pass through it annually, double what it was 3 years ago. In 2024, a massive 294-meter cargo vessel sailed from St. Petersburg to Qingdao. This ship was so large it couldn't fit through the Suez Canal or the Panama Canal. Russia opened a deep-water channel specifically for it, allowing ships that were previously deemed impossible to pass through freely. That same year, the Suez Canal's revenue plummeted from $10.2 billion to $4 billion, evaporating a full $6.2 billion. That's equivalent to Egypt losing 15% of its national foreign exchange income in a single year. Where did all that lost cargo go? Some ships chose to detour around the Cape of Good Hope, while others began testing that newly opened Arctic passage. This is the Arctic route, the first commercial shipping lane in human history opened by climate warming. We're using a climate crisis created by burning fossil fuels to open a shortcut for transporting even more fossil fuels. And the nation controlling this passage has turned geographical advantage into a toll booth. Icebreaker escort services cost $470,000 per trip, plus $7,500 per ton in transit fees. By 2030, if Russia hits its target of 100 million tons of annual cargo, these two revenue streams alone will generate billions of dollars. But there's a deeper issue at play. When traditional shipping chokepoints get blocked, whoever controls the emerging alternative routes controls pricing power for the next decade of global logistics. In February 2025, Trump announced plans to build a fleet of 40 icebreakers, while repeatedly mentioning his desire to acquire Greenland. This isn't coincidental. The Arctic route has transformed from science fiction into a commercial battleground between major powers, and this competition is only just beginning. Russia took 10 years to transform a neglected frozen sea into a cash printing machine. When Rosatom, the Russian state nuclear corporation, took over operations of the Arctic route in 2018, they immediately launched a sophisticated commercialization scheme. The core logic was simple: control the infrastructure, monopolize transit services, and set up toll points at every stage. Icebreaker escort represents the first barrier. Russia operates the world's only nuclear-powered icebreaker fleet. Out of 40 icebreakers, 8 are nuclear-powered, creating a technical threshold no other country can replicate. In 2024, this fleet completed 976 escort missions, charging roughly $470,000 per trip. For a ship making 2 round trips from Asia to Europe, icebreaker fees alone approach $1 million. But ship owners have no choice. No escort means no passage through the ice zones. Transit permits form the second checkpoint. Russia requires all vessels passing through the Arctic route to obtain permits, charging based on cargo tonnage at a rate of $7.50 per ton. For a ship carrying 40,000 tons of cargo, the transit fee hits $300,000. As cargo volume explodes, this revenue stream becomes astronomical. If the 2030 target of 100 million tons is achieved, transit fees alone would generate $750 million annually. Port services create a third revenue source. Russia has built 6 major deep-water ports along the route, including Sabeta and Arkhangelsk, offering fuel replenishment, equipment repairs, crew changes, and other services, all with clear price tags. LNG carriers in particular must undergo cryogenic refueling at Russian ports, adding another substantial revenue stream. The genius of this model lies here. Russia doesn't need subsidies because passing vessels cover all costs. While infrastructure investments are massive, including a $110 billion energy port on the Taimyr Peninsula and billions more for icebreaker construction, port expansion, and railway development, these investments can be recovered through long-term fee collection. The pricing strategy proves even more clever. Combined icebreaker fees and transit charges offset roughly 38% of the savings ship owners gain from reduced fuel consumption and travel time. In other words, Russia has precisely calibrated its fee structure to hit a sweet spot, just cheap enough compared to traditional routes but profitable enough to fill Russian coffers. Ship owners do the math and find that despite paying hefty fees for the Arctic route, it still beats detouring through the Suez Canal or around the Cape of Good Hope. The power of this business model lies in economies of scale. With cargo volume at 37.9 million tons in 2024, Russia was already making good money. But if it hits 100 million tons by 2030 and 220 million tons by 2035, the Arctic route will become one of 3 major global toll passages, alongside the Suez Canal and the Panama Canal. The comparison with the Suez Canal reveals the potential. When the Suez Canal generated $10.2 billion in revenue in 2023, it handled roughly 1 billion tons of annual transit cargo. If the Arctic route reaches 220 million tons by 2035, applying similar per-unit fees, annual revenue would reach at least $20 to $30 billion. And Russia's pricing power is even greater because it monopolizes icebreaking services, leaving ship owners with no room to negotiate. This explains why Putin calls the Arctic route a top national strategic priority. It's not just a transportation corridor. It's a money-printing machine that can run for decades, and as global warming accelerates, this machine's capacity keeps increasing. In 2024, Chinese cargo ships completed 14 voyages through the Arctic route, transporting 176,000 tons of containerized goods, exactly double the 2023 figure. In the first 8 months of 2025, this number already reached 120% of last year's full-year total, and the growth rate keeps accelerating. Behind this lies a carefully calculated cost analysis. From Shanghai to Hamburg via the Suez Canal takes 33 days and covers 10,000 nautical miles. Through the Arctic route, it's only 27 days and 8,000 nautical miles, directly saving 6 days and 25 to 35% in fuel costs. For a vessel carrying 1,220 standard containers, a single voyage saves hundreds of thousands of dollars in fuel expenses. For cargo like high-end electronics and precision instruments, those 6 days mean faster capital turnover and lower inventory costs. But what really motivated China to go all in wasn't these direct savings. It was the strategic value of supply chain security. The Suez Canal's 60% revenue drop in 2024 stemmed primarily from Houthi attacks in the Red Sea region, forcing numerous ships to detour around the Cape of Good Hope. This sounded an alarm for global supply chains. Overdependence on a single choke point means that once geopolitical conflict erupts, the entire trading system can collapse. Chinese maritime shipping handles over 90% of international trade transport, with Europe-bound trade heavily dependent on the southern route through the Strait of Malacca and the Suez Canal. Over 1,000 ships pass through the Strait of Malacca daily. Any blockade would immediately cut off China's energy imports. The Suez Canal faces constant threats from Egyptian political instability and Middle Eastern conflicts, making disruptions a perpetual risk. The Arctic route offers a completely different option. Bypass Malacca, bypass Suez, travel directly from the Pacific across the Arctic Ocean to reach Europe. While this route only operates 7 to 10 months per year, it can serve as a backup route in critical moments. For energy security and critical materials transport, this backup is invaluable. This explains China's willingness to invest $12 billion. This money flows into 3 directions: port infrastructure, icebreaking capability, and satellite navigation systems. China is investing in expanding the 360-meter deep-water terminal at Arkhangelsk Port, expected to be completed in 2020. This terminal won't just accommodate large cargo vessels, but will also provide supply and maintenance services for Chinese ships, reducing dependence on Russia as the sole service provider. For icebreaking capability, China is building 2 new icebreakers, Zhulong 3 and Zhulong 4, set to enter service in 2025 with 3.5-meter icebreaking capacity. While they can't match Russia's nuclear-powered icebreakers, they can at least provide partial escort services for Chinese cargo ships during summer months, lowering dependence on Russia. Satellite navigation completes the 3rd piece of the puzzle. 12 Beidou 3 satellites provide centimeter-level positioning services in the Arctic region, meaning Chinese vessels navigating the Arctic won't need to rely on GPS or Russia's GLONASS system. In case of conflict where GPS gets shut down, Chinese ships can still navigate safely. Now for the economic calculation. By 2030, if the Arctic route handles 3% of China's Europe-bound trade, that represents roughly $30 billion worth of goods annually. By 2050, reaching 5% would mean over $50 billion. The $12 billion infrastructure investment spread over 20 to 30 years amounts to only $400 to $600 million annually, but it delivers supply chain security and reduced logistics costs. The deeper logic goes like this. China is trading capital for passage rights. By investing in Russian Arctic infrastructure, China gains not only priority transit rights, but also shares in future Arctic resource development profits. China holds stakes in the Yamal LNG and Arctic LNG 2 projects, which annually ship over 21 million tons of LNG to China through the Arctic route, accounting for 14% of China's LNG imports. If these energy supplies came from the Middle East, they'd have to pass through Malacca and the Indian Ocean, carrying far greater risks. This isn't simple logistics investment. It's strategic positioning for the next 30 years of energy security and trade dominance. When the Suez Canal loses $6 billion in annual revenue, when global supply chains face frequent disruptions from geopolitical conflicts, the value of having a backup route far exceeds the $12 billion nominal investment. In the fall of 2024, 2 LNG transport vessels quietly docked at the Arctic LNG 2 project terminal. Both ships were on U.S. sanctions lists and should have been dead in the water. But they loaded cargo anyway and disappeared into the Arctic Ocean's fog. This is the shadow fleet game playing out on the Arctic route, finding gray zone arbitrage opportunities between Western sanctions and commercial interests. The Arctic LNG 2 project should have been Russia's energy ace. With a $21 billion investment and an annual design capacity of 19.8 million tons, it could have made Russia the world's second-largest LNG exporter. But in November 2023, the U.S. Treasury Department added operator Novatek to its sanctions list, and the EU's 14th round of sanctions delivered a knockout blow. Equipment and technology provision banned, transshipment in EU waters prohibited, financial and insurance services cut off. The sanctions had immediate impact. Foreign shareholders like Total Energies and Japan's Mitsui announced participation suspensions. 60% of project capacity sat idle, with only one of the 3 production lines planned for full operation in 2024, barely limping along. But Russia found a workaround. These vessels share several characteristics. Ship registration in non-sanctioned countries, typically Panama, Liberia, or the Marshall Islands. Ownership through shell companies, hiding true owners behind multi-layered offshore structures. Insurance coverage from Russian or non-mainstream Asian companies. AIS, or automatic identification systems, frequently turned off or broadcasting false positions. The operation model looks straightforward enough. LNG loaded at Arctic LNG 2 first travels to Russia's Vitino port in the White Sea, then moves by rail to ports not under sanctions, where it's loaded onto another batch of clean vessels bound for Asian buyers like India, Turkey, and the United Arab Emirates. These buyers know full well where the cargo originated, but because of the laundering step, technically it doesn't count as direct procurement from a sanctioned project. The data tells the story. Despite taking heavy hits, Arctic route LNG transport volume in 2024 still reached 21.86 million tons, up 8.6% year-over-year. 2 projects drove this. The unsanctioned Yamal LNG completed 320 transports throughout the year. Arctic LNG 2, through its shadow fleet, secretly shipped cargo, and while output fell far short of design capacity, at least it didn't completely shut down. The genius of this game lies in cost shifting. Sanctions closed normal commercial channels but also created black market premium space. Russian LNG now sells at 10 to 15% below market price, using discounts to attract buyers willing to shoulder sanctions risk. When buyers resell to end users, prices recover to normal or even slightly higher, with middlemen capturing the spread. And while Russia's profit margins get squeezed, at least it can sell product, bringing in cash to sustain production. Insurance arbitrage provides another profit point. After Western insurance companies withdrew, Russian state insurance companies and some Asian insurers filled the void, charging premiums 2 to 3 times normal levels. But for high-value LNG cargo, these extra costs remain bearable. Ship owners, insurers, and middleman traders form a community of shared interests, collectively harvesting excess profits from the cracks in the sanctions regime. How long can this model last? The key lies in buyer markets. India's energy imports from Russia surged in 2024, making it the biggest willing participant. While China publicly claims to follow international rules, through private enterprises and offshore procurement, it has in fact increased Russian energy imports. As long as Asian market demand stays strong, the shadow fleet has room to survive. From a financial perspective, this is a risk versus reward calculation. Western sanctions raised transaction costs and legal risks, but also eliminated some competitors, allowing remaining players to enjoy monopoly rents. For capital, wherever excess profits exist, incentives to break rules follow. The shadow fleet on the Arctic route is just the latest version of this eternal logic playing out in polar waters. In March 2025, Russia announced it was raising its Arctic route annual cargo targets to 100 million tons by 2030 and 220 million tons by 2035. What do these numbers mean? Global maritime trade volume totals roughly 12 billion tons. If the Arctic route reaches 220 million tons, That's less than 2% of the total. Seems insignificant, but the key lies in cargo types and strategic value. The Arctic route primarily transports three cargo categories: energy products like LNG and crude oil, high-value minerals like nickel and copper, and high-end manufactured goods. These are all high-price, low-volume items, small tonnage, massive cargo value. 220 million tons of energy and high-value goods could represent over $200 billion in product value. The impact on traditional shipping patterns is becoming visible. When the Suez Canal generated $10.2 billion in 2023 revenue, it handled roughly 1 billion tons of cargo, averaging about $10 per ton. If the Arctic route diverts 5% of high-value cargo, the Suez Canal loses not just 50 million tons of volume, but the highest-priced portion. Transit fees for LNG, containers, and specialized cargo far exceed those for bulk commodities. This explains why Suez Canal revenue crashed 60% in 2024, while volume only dropped 50%. Egypt has started fighting back. In May 2025, the Suez Canal Authority announced fee discounts of 12 to 15% for transit vessels, with a special 35% discount for LNG carriers. This is clearly defensive pricing, attempting to use price wars to reclaim market share. But here's the problem. Discounts can't change geographical distance. Going through the Suez Canal still means traveling 3,000 nautical miles farther than the Arctic route, with time costs and fuel costs right there in the equation. The real contest comes after If global warming continues, the Arctic route's navigation season extends from the current 7 to 10 months to 8 to 9 months year-round, or even achieves full-year navigation. That completely rewrites the rules. At that point, the Arctic route stops being a seasonal alternative and becomes a permanent option on equal footing with the Suez Canal and the Cape of Good Hope. Market projections show that if the Arctic route achieves year-round navigation, maritime shipping costs from China to Europe will drop 15 to 20%, saving Chinese enterprises over $10 billion annually in logistics expenses. The value of supply chain resilience proves even harder to quantify. Three parallel routes mean if anyone has problems, backups exist, which is critical for global trade stability. But there's a massive paradox here: carbon neutrality commitments. Russia signed the Paris Agreement in 2019, pledging to achieve carbon neutrality by 2060. But the Arctic route primarily transports fossil fuels. In 2024, LNG accounted for 58% of cargo volume, crude oil another 20%. In other words, Russia is using fossil fuel exports that accelerate climate change to support a route that climate change opened. Ironically, the Arctic route itself gets packaged as green shipping. Russia claims the Taimyr energy port will use wind power, icebreakers run on nuclear energy producing zero emissions, and the shortened route reduces vessel carbon emissions by 30%. But all these emission reductions rest on one premise: continuing to transport fossil fuels. From a business logic perspective, this paradox has no short-term solution. Global LNG demand is projected to peak in the 2030s at 130 million tons and still maintain 119 million tons by 20. Arctic LNG will have stable markets for the next 20 to 30 years. Countries like Russia, China, Japan, and South Korea won't abandon this trillion-dollar energy business for climate commitments. The real variable lies in technological breakthroughs. If clean energy sources like green hydrogen and nuclear fusion achieve commercial breakthroughs in the 2030s, fossil fuel demand will cliff dive. At that point, the Arctic route's cargo structure will completely transform, shifting from transporting LNG to hauling nickel, copper, rare earths, and other minerals needed for new energy industries, or transporting green hydrogen and ammonia fuel. This could represent an even bigger market. The global new energy industry needs tens of millions of tons annually of nickel, cobalt, lithium, and rare earths, and the Arctic region happens to be where these minerals concentrate. Greenland's Kvanefjeld deposit holds 1.5 million tons of rare earth reserves, and Russia's Arctic region contains 20% of global nickel reserves. If the Arctic route transforms from fossil fuel highway to new energy mineral corridor, the scale could exceed what exists today. This is capital's logic. No matter how energy transition evolves, the Arctic route will find new profit models. In the fossil fuel era, it transports LNG. In the new energy era, it transports rare earths and nickel. The one constant remains the monopoly rent derived from geographical advantage, and as climate warming continues, this rent keeps expanding. At its core, the Arctic route is a capital game about geographical rent. When the Suez Canal loses $6 billion in annual revenue, when global shipping companies pay billions in extra costs to detour around the Cape of Good Hope, The Arctic route's commercial value transforms from theory to reality. Russia turns frozen shipping lanes into toll booths, with a 2030 target of 100 million tons generating billions in annual revenue. China trades $12 billion in investment for supply chain security, bypassing the twin choke points of Malacca and Suez. Western sanctions prove ineffective against shadow fleets as capital finds arbitrage opportunities in gray zones. The rise of this route exposes the fundamental logic of how the global economy operates. Whoever controls critical passages controls pricing power. If the Arctic route reaches 220 million tons in scale by 2035, it will stand alongside the Suez Canal and Panama Canal in a three-way balance, reshaping trillion-dollar logistics market dynamics. And as climate warming continues, with navigation seasons extending from 7 months toward year-round operation, this game is only beginning. The real question isn't whether the Arctic route can commercialize. It's what happens to global supply chains, energy configurations, and geopolitical competition when it truly becomes a regular shipping lane. For capital, this represents a trillion-dollar track with guaranteed growth. For humanity, it's Pandora's box opened by climate crisis. The speed at which ice melts determines when this game reaches its endgame.